Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're taking a look at two retail stocks who are set to report their quarterly earnings results next week. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the two retail stocks set to report next week, I just want to quickly go through some broader market overview to give more context for what's going on. So stocks did bounce back in the last two sessions last week after the market had finally snapped its winning streak during the week of November 8th. So that was early in the week. Last week, stocks finally made a pullback after they had just continued to climb to record high after record high after record high. So Wall Street decided it was really time to take profits after that months-long rally with all three major U.S. indexes, as we said, continuing to hit new highs to start the second month of the fourth quarter. Many pointed to continuing inflation, and rightfully so. After inflation hit 30-year highs in October, investors were now left to decide if that hot CPI reading will force the Fed to start lifting rates sooner than projected. So that was the reasoning why people said the market fell, but it could have also just been time that it was some technical levels got a little overheated, time to just take a breather, take the winnings off the table, and then jump right back in. We were a little mixed so far on Monday morning, so nothing indicating where we're going to head in the next couple of weeks or as we finish out the year heading into 2022. So with that in mind, though, the central bank has already started to taper its bond buying program, and it plans to conclude its stimulus-focused purchases by June, with its goal at the moment to keep its core interest rate at that current rock bottom level until then. But as we mentioned, if we continue to see these really high inflation figures, they might be forced to raise rates before that plan, which is so far early summer of 2022. But the market's quick rebound, as we said last week, could mean the Wall Street really is remaining pretty sanguine about it and isn't that worried about these rising prices and persistent supply chain bottlenecks. And we're seeing people struggle to fill job openings in the U.S. I think I read there was 10 million job openings last week, which was above the pre-pandemic level. So, there's lots of worries, but still Wall Street's telling you they're not as worried. And one of the big things to note is that the rising prices have not shown up in the S&P 500 margins outlook for 2022 or 2023 just yet. Obviously, maybe they could, but we aren't seeing any of those results start to turn worse with these rising prices. So with that in mind, we're going to take a look at two retail stocks that are set to report their results next week. And the first one of those two stocks we're looking at is Best Buy, which trades on the ticker BBY. It's set to release its Q3 FY 2022, so it's already on its fiscal year 2022 earnings call on Tuesday, November 23rd, so next Tuesday. Quickly, we're just going to go through the basics and then look at what to expect and what the stock has done, and all of that heading into that release next week. So Best Buy has clearly benefited from the coronavirus forced remote schooling that now seems like forever ago, in that initial remote work push as people were forced to buy everything they needed to do school or work from home kind of overnight. Best Buy, we know they sell smartphones, TVs, connected appliances, nearly anything else in our consumer electronics world that you might want to buy. You can probably find it at Best Buy. They've benefited from people buying laptops, tablets, and more. And people are going to continue to buy those no matter what the work and school world looks like. But they just benefited particularly kind of in that overnight setting where everyone had to ramp up their at-home electronics devices. They have, like all other retailers, spent the last several years working to improve their digital commerce offerings in order to succeed long-term, where millions of people are really just wanting as many different convenient options to shop in our Amazon-style world. So Best Buy's revenue climbed 8.3% last year for its best top-line expansion in nearly 10 years. Meanwhile, its adjusted earnings jumped 30%. And then we should also note one of its big digital pushes is that the company joined Walmart and some other retailers in a subscription service space. So the company announced back in April that it was piloting a new membership program that at the time it called the Best Buy Beta. The service has since been called Best Buy Total Tech, and it's a $199 a year service that's offering exclusive member pricing, various other things. So you get free delivery and standard installation and all eligible Best Buy purchases, free Geek Squad tech support, which they claim is offered around the clock throughout the year, and various other offerings. So we'll see how, if this is able to help the business going forward, as everyone tries to get this subscription business to encourage more people just to stay in their ecosystem and not worry about shipping costs or anything like that, and just buy as much from Best Buy. And this $199 service could actually in the long term be very beneficial, but it has not been around just long enough yet to know how it's impacting its top or bottom line. So Best Buy said on its Q2 earnings call in late August that it was upping its guidance, and we should note that its revenue climbed 20% last quarter, and its adjusted earnings climbed at 75% last quarter to easily top our bottom line estimate by over 50%, and this is the second time in a row it beat our bottom line estimates by over 50%. So looking ahead, it is coming up against some tough to compete against periods in the year ago quarter. So we're calling for a 2% decline year over year on the top line and a 7% decline on the bottom line, just compared to those stellar performances last year during this period. That said, we just noted that they beat pretty easily the last two quarters on the bottom line, so we could see that change. And then overall for the year, we're expecting 10% growth on top of that big year last year, so all the way up to about $52 billion, and then another roughly 27% growth on the bottom line this year. At the moment, we're also calling for a bit of a pullback then in terms of what they're expected in 2023, but you never know how the rest of the year and the vital holiday shopping period turns out. It is also worth noting that for 2022, so its current year, and 2023, next year, its most recent bottom line estimates are coming in well above the current consensus estimates. So the FY 2022 figure is up 7%, and the 2023 figure is up nearly 9%, which means the most recent analyst revisions are coming in well above the consensus, which, if the basic sense here is that the most recent should be the most accurate because they have the most up-to-date information on what the company should be expected to report on the bottom line going forward. So that's some good signs for Best Buy. We should also note that the shares have soared 14% in the last month alone, and they just hit brand new highs of about $137 a share, though we should note that they pulled back Monday morning, and the last time I looked, they were down around about 2.5% at the moment. And we should note that this is part of a longer run. Best Buy is up about 190% for the last 5 years, though the recent climb has pushed it oversold technical levels, though the bit of a pullback is a positive sign. We could see more of a pullback as they reached back to technically not oversold levels. So the RSI levels are 70. Anything over 70 is overbought, and anything below 30 is oversold. So they have now gone from nearly oversold to overbought along with the broader market in about a month. And the recent pullback is making things look much more enticing. And we could see just more of a pullback heading into its results next week that could set up a better buying opportunity. That recent resurgence has seen it jump well above its 50 and 200-day moving average after it had kind of become stagnant so far in 2021. And despite its big push and trading at new highs or just below its new highs, the stock is trading at about 14.1 times forward 12-month earnings estimates, which is well below its industry's average of about 33 times. And it's trading about 10% discount to its own year-long highs in terms of forward 12-month earnings. We should also note that its 2.12% dividend yield currently crushes the S&P 500 and the 10-year U.S. Treasuries 1.6, and easily comes in above Walmart's 1.5% dividend yield. We should also note that last quarter, the company upped its repurchase program slightly. So it says now it will repurchase more than $2.5 billion worth of its own stock compared to approximately $2.5 billion. So nothing concrete in terms of how much farther they're going to go, but always a positive sign to see them try to return more value to shareholders. So at the moment, that positive earnings revision activity helps the stock land ASAX rank number 2 buy, along with both A grades for growth and value in our style score system. So therefore, Best Buy might be worth considering as a near-term play if it's able to pull back a little bit, setting up a near-term buying point. But longer-term investors don't necessarily need to try to time this tech-focused retailer who's going to continue to benefit from a space where all people want to do is buy electronics, personal electronics, handheld devices, TVs, laptops, all of that kind of stuff. This new $200 a year service could prove to be really helpful as well. So longer-term investors might not need to be as concerned about buying this retailer that also has a really solid dividend yield, but you never know what's going to happen in the near term, especially amid these continued supply chain worries, rising prices. So buying anything for the upcoming earnings results on Tuesday is always risky, but longer-term investors don't need to worry about timing things just as much. And now we're going to move on to a totally different stock that also jumped hugely on Monday morning, and that is Dollar Tree, which trades under the ticker DLTR. And its Q3 results are also due out Tuesday, November 23rd. So we're going to dive into a little bit of the basics before we dive into why it's soared so much. So Dollar Tree stock had tumbled in 2021, driven down deeper following pretty disappointing second quarter results. Near the end of August, Wall Street had dumped the stock after the discount retail powerhouse warned that supply chain setbacks and rising costs were going to impact its profits. But then Monday, things were up big on news that came out late last week of an activist investor push. So overall, the company is a discount retailer that operates around 15,000 stores. This includes its namesake Dollar Tree stores as well as Family Dollar. So the company sells everything at its stores for $1 or less, which does stand in contrast to rival Dollar General. Meanwhile, Family Dollar sells many items at $1 price points, along with a broader array of offerings in general that are between $1 and $10. Dollar Tree doesn't necessarily compete with the likes of Target and Walmart, which is a good thing, even though Target and Walmart are often considered discount retailers. These are really deep discount retailers when you're saying you're going to sell everything for $1 or less. That said, Wall Street clearly has not loved Dollar Tree over the last 5 years. They've certainly not loved its purchase of Family Dollar, which it made back in 2015. And management noted last quarter, as we mentioned, that these inflationary pressures are continuing to negatively impact the firm. And this has obviously hurt when your business model is that you sell for everything for $1 or less. There's not really much wiggle room on the pricing front. So this brings us to the news we're talking about today. And the reason it's up so big is that the announcement came, or the reports started to come in after the closing bell on Friday, that activist investor Mantle Ridge had acquired about $1.8 billion position in Dollar Tree with the intention of making the company just what all activist investors hope to do, make the stock price go up, rejigger things, work things out. So Dollar Tree shares have gained only about 45% during the last 5 years, while the S&P 500 has climbed around 120%. So clearly things need to be changed. The company said that they hope to make improvements at Family Dollar, which, as we mentioned earlier, has not proved to be very successful since it made that purchase in 2015. They also hope to eventually change the pricing strategy. And we should note that there was signs of this activist investor push in September when the company saw its stock price jump for the most in one day in a really long time, when it boosted its share repurchase authorization, and it said it would move above the $1 an item price point. So that was obviously what they were famous for, but they said they were going to start being more willing to offer a variety of food and household items above that price point back in September. And now we've seen the activist investor news come out more recently. So this is obviously something that Wall Street's hoping will help boost its profits, because I always find it so shocking that any business can succeed when they're selling things that clearly at some point cost more than $1 to get all the way to their store. But we'll see how this actually works out. We should note that Mantle Ridge wants to help Family Dollar live up to what they see as its potential, because we've seen Dollar General go on a massive run over the last several years as well. And we should note, though, this also isn't the first time that activist investors are trying to make a change at Dollar Tree and try to impact things at Family Dollar in 2019. So actually early 2019, a company called Starboard Value had urged Dollar Tree to sell Family Dollar. That obviously never happened. So we'll see if things are different this time around. We should note that the current year sales are expected to climb 3% to about $26 billion. And its adjusted earnings are expected to slip about 2%. But then we're calling for another top-line growth of 4% next year, and then an impressive 10% growth on the bottom line next year. So we're currently calling for Dollar Tree. Its earnings revision activity has been rather mixed. Recently, though, it's down significantly from where it was before its second quarter report. We should also note that the company has topped its bottom line estimates in the trailing 4 quarters, including rather big beats in 3 out of those 4 quarters. So that's always a good sign. In terms of where broader brokerage recommendation sentiment is at the moment, we have 17 different brokerage recommendations for the stock, and about 10 are sitting at a hold with only 1 sell, and the rest are sitting at either buy or strong buy. So most are sitting at a hold at the moment, which is nothing terrible. So that's, at least everyone's not saying to dump the stock completely. Some of the recent momentum, that mid-September momentum when it started to say they would mess around with having prices and things cost more than $1, saw it surge, and then it's come back to earth a little bit recently, and then the huge push on Monday has it back above those overbought RSI levels. So let me check real fast. The stock is currently up about 14% to $129 a share, and it hit new records earlier this morning of about $132 a share. It's actually crazy. Both of these stocks that we're talking about today are trading for almost the exact same price. So currently, Dollar General is a Zacks rank number 3 hold right now, and investors might want to keep their eyes peeled on the stock, though it might be a bit funny timing to try to get in at the moment with this activist investor push news just coming to light. It is worth diving deeper in if you're considering what to do with Dollar Tree at the moment, because supposedly, based on some Wall Street Journal reports, that the activist investor who is trying to infiltrate Dollar Tree is working with Dollar General's former chief executive, who was widely helped credit with turning that business around. So this could be a long-term positive for the stock, even though it's now trading at new highs. It might scare some people off at the moment, but it's worth at least adding it to your watch list as the company who has seen these other discount retailers surpass it recently maybe could start to turn things around as it reworks its price point and decides we can't sell everything in our entire store for $1 or less, and starts to wiggle around. And I also read in that Wall Street Journal story that the activist investors had probed the shoppers and found that people were willing to spend more than $1 at Dollar Tree stores. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.